Back, everyone. Hour 2 of Midday SuperTalk Mississippi, live from the Element Wealth Studios. And joining us now is Jeremy Nelson, partner with Element Wealth in the Element Wealth Studios. Jeremy, good to see you.
Always a pleasure to be here.
Yeah, so we're just taking a look at the markets today. Haven't even talked about that. The Dow up 291, NASDAQ up less than 100, S&P 21 points at the current reading. What's going on today to drive the markets? Any news?
Nothing. I mean, right. It's a quiet period. Everyone's kind of waiting to see is the forecast of the 50 basis points right, or is the Fed going to surprise the market and do 75? I mean, most are in the 50 basis point camp, which is where we are. You know, I think that they want to begin to slow down here. This is just kind of creating a base in the market right now.
Yeah. Well, and we've also got CPI out tomorrow, 8:30 our time, I believe, right?
Yep.
So we had the PPI last week, and it sent the market downward because it was hotter than expected. The producer price index, of course, the cost of inputs, sort of the wholesale reading, if you will. Tomorrow is more the retail reading, the CPI.
Yeah, and with inflation, what we see is that the inflation peaked in the summer. It's going to be bumpy on the way back down, but we're very, very convinced that we've seen the peak inflation and that it's coming down.
Yeah, I think so too. And of course, like it or not, the Fed's goal is to push people out of a job. And we've seen some shedding of jobs and announcements. Even Goldman Sachs a couple of weeks ago said, we're going to let some jobs go.
Yeah, what you're seeing is a bit of a white-collar recession in jobs,
right? Yeah, exactly.
But there's still major shortages in your more traditional blue-collar jobs that are out there. So, overall, the labor market's still strong. You've got a really low unemployment rate. That unemployment rate will likely tick up a little bit as we see more and more these tech and financial firms, cutting their workforce. Ultimately, that's a good thing for these businesses, though, right? I mean, they kind of got fat. We talked about this a few weeks ago. They're trimming the fat. Ultimately, it'll be good for them long term.
Yeah. So we were talking off air. Where do you see? So here's a possible scenario. Get you to comment on it. I think most economists now, if there is such a consensus among economists, say first half of the year, don't expect it to be too rosy. Second half, we might see a fairly strong bull market. But first half of the year, as we sort of flush through the interest rates, maybe tamping down capital investment, consumer spending, and so forth, could be a little rocky for the markets, but there's still a bunch of cash out there looking for a home. How do you see it playing out?
Well, it's interesting because if you look at the pre-election year, the third year of the election cycle, it actually tends to be very strong in the first part of the year and then kind of flat in the latter part of the year. It is going to hinge on the economy. You just generally don't see a recession, though, before the Fed is done hiking rates. Consensus is that the Fed is going to end in March, right? So they're going to go 50, 25 on February 1, 25 in March. And then you would probably see more recessionary pressures. We had talked about seeing recessionary pressures maybe later in the year. I'm moving that forward a little bit closer to maybe the halfway point of the year or so. I think there's a 75% probability that you do get a recession next year. It'll likely be probably pretty mild. So I can see the case where you actually you have a strong first quarter, then it starts to slow down, get a little rough before you get a year-end rally.
Interesting. So, of course, when you talk about recession, the classic definition, 2 consecutive quarters of contracting GDP. But there's varying degrees of that. We're not talking about any major pullback in your view, are we?
No, I think what you're going to kind of get is a year where GDP is kind of down 0.5% to up 0.5% when it's all said and done. Okay. And like this year, consensus is that we have not been in a recession. There was just some funky stuff going on with net exports and inventories and stuff in the first half of the year. We had a strong Q3. We're going to have a reasonable Q4. So again, I don't see us going from a strong Q3 and a reasonable Q4 into a recession in Q1.
Yeah. I think the reason, and get your take on this, that most people really aren't discussing the recession concept too much is you typically associate that with significant loss of jobs. You think about high unemployment. We're not experiencing that.
Corporate profits are up, and you've got an unemployment rate below 4%.
Yeah. That's not
a recession.
Right, exactly. Yeah. So, but GDP may pull back. We may have a couple of quarters of that. That possibly could spook the market a little bit, but I don't know.
I think the big thing that investors should be watching and paying attention to is corporate earnings, right? And that's where, as we're going into next year, consensus expectations that operating earnings are going to be up 13-14%. That might be a little rosy.
That sounds high.
Yeah.
Well, if that's the case, we got to think we're in for a pretty significant bull market.
Well, that and exactly, and so you've got consensus estimates at 13-14% earnings growth, but then everyone's talking about us going into this big recession. Those two things don't jive.
Don't. Well, CEOs of the two of the largest banks in the country, Bank of America and J.P. Morgan, they certainly don't align on their outlook whatsoever. J.P. Dimon, CEO of J.P. Morgan, Jamie Dimon, excuse me, CEO of J.P. Morgan, he comes out and says, I think it's going to be bad.
Now, but he's been saying this for months.
He has.
Right? And now, look, Jamie Dimon, best bank CEO out there.
No doubt.
I mean, no doubt about it. When he speaks, I listen.
No doubt.
Again, I'm a little more in the Moynihan from Bank of America, where I see a mild recession. I don't see a catastrophic recession, but time will tell who's right there.
Yeah, and Jamie Morgan also warned against rising fuel prices. He says we're not out of the woods on this deal yet. He said that. In fact, he said it would endure for a long time.
I totally agree with that. One of the themes that we're looking at in our kind of forecasts coming up here for next year is focusing on physical, not digital.
Okay.
And I think that energy and all and physical assets are critical. It's going to be a better place to invest than digital next year.
Yeah. Now, a lot of folks out there are looking at their 401k plans and their nest eggs, and they're concerned. Mm-hmm. What would you say to them?
Well, what I would say is kind of going back months, what we've been saying. Said, hey, don't hit the panic button. Well, look where we are today. We're way up. Be diversified, right? So the reason that 401ks are down as much as they're down right now, stocks are down 16% or so on the year. That's not crazy. That's not totally unusual for stocks. But diversified portfolios are down about the same because interest rates have gone up, bonds have gone down.
Yeah.
As we go into next year, bonds become ballast in the portfolio. So a diversified portfolio holds up much better, right?
Okay.
So if you got half in bonds, half in stocks, what I would say is probably keep the fixed income a little more high quality versus credit sensitive, like high yield and things that are correlated to the stock market. If you're investment grade corporate or mortgages, treasuries, things like that, that's going to provide ballast in your portfolio. I wouldn't go into next year just full on all tilt bullish, but I also wouldn't go into it completely bearish. I think right now is a good time to be diversified, right? This is why we diversify. And I think on a longer term basis, beginning to tilt towards value, maybe some mid-cap where there's relative longer-term value is a good place to be.
Yeah, so the question is, when we are led to the next bull market, which is going to happen, is it going to be tech-led value, Or is it going to be value stocks? Is it going to be growth stocks, tech stocks, typically in that category? That kind of led us to where we are. Is that what's going to happen?
I do not see tech leading in the way that it has led for the last decade.
All right. We are up against a break right here. You can hang around with us. We'll talk some more. We'll maybe do a little bit of chatting on fiscal policy and tax policy.
My favorite.
That's coming up here.
Yep.
So we're coming right back in the Element Wealth Studios with Jeremy Nelson, partner at Element Wealth. Stay. Talk Mississippi live from the Element Wealth Studios. Jeremy Nelson, partner at Element Wealth. Our guest just talking about the economy, markets, finance, etc. So one of the things that I've talked about on the program, Jeremy, that's not getting a lot of attention right now is the individual provisions of the Tax Cuts and Jobs Act, also known as the Trump tax cuts. I think that's probably how it's better known. The individual provisions expire at the end of 2025. Nothing essentially is going to happen between now and then, especially with the Republicans controlling the House.
Yep.
They ain't getting through. All right. So if in 2024 election year, Republicans don't control the House, the Senate, and the White House, this may be the biggest war that I don't think people are talking about we've ever seen in the Congress of the United States, because the Democrats want to completely repeal the thing and replace it with a way more progressive tax system. Want to tax wealth, increase capital gains, everything individual related. That and they also, of course, want to increase the threshold for deducting state and local taxes, the so-called SALT deduction, which affects mainly people in the high-tax blue coastal states. I don't think folks are talking about this enough. This could affect them. I know it's 3 years down the road, but if capital gains taxes go up and some of the other provisions, that could be an issue.
Yeah, so you're predicating that on the fact that we would be replacing it with a new proposal. Because if all that happens is that it's repealed and we go back to what it was, that's not that big of a deal. That's not the end of the world, right? If you were to replace it, though, with the higher capital gains rates and 40+%, top marginal rates, and tax on the wealthy, then that does become a problem because it starts to hit consumption significantly. So that does begin to hit GDP in a big way.
Yeah.
But if it just repeals back to what it was, then that's not that big of a deal.
You don't think so? Like the pass-through provisions, I find to be fairly significant.
So the QBI deduction is really good for small business owners.
Sure.
Look, I think tax attorneys will do very well because you got opportunities with arbitrage between C corps and S corps and all those sorts of things that they can use there. But in general, it doesn't have that big of an impact on the average wage earner.
I hope you're right. I really do. And I think you may be right in terms of the average wage earner, but certainly from if you look at the higher end of the income scale and you look at investing in portfolios there, how that might impact markets, which could have an impact on the average wage earner, of course, with their savings.
I think look, and I want lower taxes and less government spending. That's what I want. But you have to go back and look at, how did the economy do? How did markets do back when rates were where they were, which they would revert to, and it wasn't catastrophic.
No, I would agree with that.
That's why I say it's a small net negative, but it's not a catastrophic situation.
Okay. We shall see.
Yeah.
But what I'd like to see is making them permanent, honestly. I think overall it's a fairly good structure. And the Democrats won't admit it. Those who oppose the TCJA, it actually is more progressive. It took people off the tax rolls.
Well, I think the number one best thing about it was for the average American taking the standard deduction up to $12,000, $24,000 for a husband and wife. I mean, that was big.
Right. And it's increased since then because of the indexing and so forth, yeah.
But, I mean, that, to me, it just simplified the whole process, was great for, for the average American. And I think it would be a shame to get rid of that.
Yeah, I would agree. And it certainly simplified the tax preparation process. Most people don't itemize because they don't have, if they're a couple married filing joint, they don't have $24,000 of itemized deductions.
Yeah. Well, they might now with mortgage interest rates.
Yeah, at the rate that's going. So where do you see? Let's talk about that. Where do you see the trajectory of rates? Most are saying, as you indicated in the last segment, 0.5 point this month. That's going to. We're waiting for that Wednesday, I think. Right? Yeah. Fed Powell will give us the word there, and then maybe 2 or 3 quarter-point hikes in the first quarter, first half, as you indicated.
Yeah.
Are they going to pivot after that? I mean, will we see enough of a slowdown where they say, okay, we got to pull back?
I think they pause. I would not expect any rate cuts until September.
Okay. Well, that could be significant. When even then a hint of that, the markets take off.
Well, if they pause and inflation is coming down and breaking below 5%, then effectively, if the Fed funds rate's at 5% and inflation's breaking below that, then Fed policy is actually very, very tight at that point in time.
Yeah.
So it'll be interesting to see how quickly they react and adjust back down. I think that they're going to keep it up there a little while longer, and that's largely why we think there's a 75% chance of a recession next year.
I would agree. So something else that we talked about last time you were here, it's worth discussing again, the opportunities with traditional fixed income securities that we hadn't had until now. It's been zero for the most part.
Well, so think about this. So I was sitting there pouring through research reports. We're getting ready for our annual forecast. We're kind of setting up positioning for next year, and I'm reading Ned Davis research, and their year-end estimate is 4,300 on the S&P 500 for next year. Mm-hmm. So that's 7-8% up from where we are today. Well, I can get 5% on a 2-year corporate bond.
Yeah.
Right? And so at this point, I really believe that the greatest opportunity is probably in fixed income. And it's an area where people are shying away from because they just lost money this year. But to me, it's presented, a really safe alternative and a good diversification piece in portfolios.
Yeah. Well, it's certainly it's better than zero. I mean, so now you can actually park your money and not do anything, and just on T-bills make 4 or 5%.
Yeah, as a portfolio manager, I mean, the fact that we've actually got some income coming off the fixed income, I mean, it just makes our lives so much easier because you're not having to stretch and find riskier and riskier assets to get yield in the portfolio and then get waxed in a COVID or this year. That's
a good point. And corporate grade bonds as well, opportunity and dividends.
Yep. Yeah, look, and that's why from a stock allocation, kind of why we favor value is with the inflation, we think that companies that actually make money and pay dividends are going to be able to increase those dividends.
Okay.
Which is going to make them more and more and more attractive. This could be a period like that 2003 to 2007, right, where, look, growth companies were making money, they were doing well, but value continued to significantly outperform in a much higher interest rate environment.
And so typically, just for the benefit of our audience, the industries that you would place in the category of value stocks.
So value stocks, I mean, you're going to largely see your utilities, financials,
healthcare.
Just healthcare. Healthcare can kind of be growth and value. There's like pharma, and then there's like a United Healthcare, it's a little more of a growth company. But yeah, that's kind of just boring companies that make stuff, right? That's going to be a pretty good place to be. Or companies that provide energy to you. Those are going to be good places to be.
Yeah, it sure seems like. And speaking of energy, any crystal ball there where all that's going? So many factors.
So many factors there. Look, I mean, in the U.S., this administration has limited future production, right? So what they didn't necessarily cause the prices to go up this year because it was future drilling that they were limiting. But all of those constraints on future supply support higher prices in the future. And we don't know exactly where this Russia thing is going to go. We don't know how cold it's going to be in Europe this winter. So I would not be selling energy here. I think that there's some interesting room to continue for higher prices.
Yeah, we're still approaching the period where consumption demand increases, and we haven't really seen the impact of that yet on the rather tight supply. Yeah. Most of which is a function of fiscal policy. Jeremy, always a pleasure, sir. Appreciate the insight. I'm sure we'll be talking to you soon, and let's keep our fingers crossed for a so-called Santa Claus rally. Right?
Hey, that would be a great way to end the year.
Jeremy Nelson, partner at Element Wealth, has been our guest here in the Element Wealth studios on Middays. We're coming right back. Stay with us.
All right.